Ever look at your portfolio and feel like your stocks are just sitting there? Not really rocketing up, but not crashing down either. Just flat. Well, what if I told you there's a way to get those stocks to pay you a regular income? Kind of like a landlord collecting rent. Today, we're going to break down a really popular strategy for doing exactly that. It's called the covered call. All right, so here's the game plan for today. First, we'll talk about why this strategy is so relevant, especially in uncertain markets. Then, we'll get into what a covered call actually is. After that, we'll look at the two main ways you can do it, either yourself or through an ETF. We'll even look at a couple of popular ETFs, JPI and JPQ. And finally, we'll wrap up with a big one, the ultimate trade-off you absolutely have to understand. Sound good? Let's dive in. Okay, first things first, why are we even talking about this? What's the point? Well, it really all boils down to one simple problem: how to generate some cash flow when stocks are just moving sideways. And that's the central question, isn't it? If your stocks aren't appreciating in price, how on earth can they still pay you? Where does that money come from? It's a great question, and it's what we're here to answer. This is the exact challenge so many investors face. You've got these long-term holdings, these companies you really believe in, and you definitely don't want to sell them, but at the same time, you want them to, well, do something for you. You want your assets to be working, to be generating some kind of cash, especially when the overall market is just treading water. All right, so that brings us to the mechanics of it all. How does this covered call thing actually work? Let's break it down. So what exactly is a covered call? Well, in the simplest terms, you take a stock that you already own, and this is super important, you gotta have at least 100 shares of it, and then you sell a special kind of contract against those shares. That contract is called a call option. And here's the cool part: just for selling that contract, you get paid cash immediately. That cash payment, that's called the premium. Honestly, the best analogy I've ever heard for this is that it's like renting out your stocks. Think about it. Someone pays you a rental fee. That's the premium, in exchange for the right, but not the obligation, to buy your stock from you later at a price you both agree on. And the best part is, you collect that rent money right away, up front. No matter what the stock does next, that cash is yours to keep. And the process itself is actually surprisingly straightforward. It really just boils down to 3 simple steps. Step 1, you own at least 100 shares of a stock. Step 2, you sell one call option contract against those shares. And step 3, you collect the cash premium as income. That's really it. It's this simple, repeatable loop: own the shares, sell the option, collect the cash. Okay, so you're probably thinking, this sounds pretty interesting, but how do I actually do it? Well, you've basically got 2 main paths you can take. You can go the do-it-yourself route, or you can just buy an ETF that does all the heavy lifting for you. And really, this choice just comes down to how hands-on you want to be. If you're a DIY investor, you get full control. You pick the exact stocks, you set the prices, you manage the timing, everything. But let's be honest, it requires a good bit of knowledge about options, and it's definitely an active management process. On the other hand, the ETF path is like the easy button. It's totally hands-off. You just buy the fund, and a team of professionals handles everything for you. No need to touch an option contract, they just send you the info. So to make this a little more concrete, let's zoom in on that ETF path. And we're going to look at 2 of the most popular funds out there that use this exact strategy: JEPI and JEPQ. Now, what's interesting is that these 2 funds kind of use the same engine, but they are absolutely built for different kinds of racetracks. You can think of JPI as your steady, reliable sedan. It's focused on large-cap, established U.S. stocks and aims for smoother, less volatile returns. Then you've got JPQ. That's the sports car. It's focused on growth and tech stocks, the kind that have a lot more volatility. The whole idea with JPQ is to take that high-growth exposure and convert that volatility into income. So let's pop the hood on JPI first. You're going to see a lot of familiar names in here, right? We're talking Alphabet, Amazon, Johnson & Johnson. These are the titans of the industry. It's a portfolio that's clearly built to be a stable bedrock. Okay, now let's switch gears and look at JEPQ. And wow, it's a completely different vibe, right? Look at that. NVIDIA is a huge part of this fund. Then you've got Apple, Microsoft. This is basically a who's who of the tech world. And the reason for that is simple. these stocks tend to be way more volatile. And in the world of covered calls, volatility can actually be your friend because it often means you can collect bigger premiums. So JEPQ is trying to convert that tech volatility into a stream of income. Okay, I really want you to lean in for this next part because it is absolutely the most crucial thing to understand about this entire strategy. As we all know, there's no such thing as a free lunch in investing. So let's talk about the ultimate trade-off here. What do you gain and what do you have to give up? Seriously, if you take away only one single thing from this whole discussion, let it be this. Income is created by selling your upside potential. That cash premium you get, it's not free money. It doesn't come out of thin air. You are literally being paid to agree to a ceiling on your potential profits if the stock suddenly takes off like a rocket. So what does that mean in the real world? Well, it means your performance is going to be totally dependent on what the market is doing. In a roaring bull market, when stocks are just screaming higher, funds like these are almost guaranteed to underperform. Your gains are capped, remember? But, and this is a big but, in a flat, choppy, or even a down market, that consistent income they generate acts like a cushion. It helps soften the blow and can actually help you pull ahead. So, with that trade-off in mind, why have these funds gotten so popular? Well, it really comes down to a few key things. People love the idea of getting a monthly income distribution. They want professional management because, frankly, they don't want to mess with options themselves. They get broad diversification, and it's all wrapped up in a super simplified, easy-to-access package. And this brings us to maybe the most important strategic point. These funds are designed to complement a growth portfolio, not replace it. This is so key. Think of your core growth investments as the engine of your car. That's what's going to drive you forward over the long haul. A fund like JEPI or JEPQ, that's like your suspension system. It's not there to make you go faster. It's there to make the ride smoother and more comfortable along the way. So, at the end of the day, it all boils down to one simple question you have to ask yourself. For your portfolio, is consistent income worth giving up some of that explosive upside? It's like in baseball. Are you willing to trade the chance of hitting a grand slam for the near certainty of hitting a single every single time you're up to bat? There is absolutely no right or wrong answer here. But understanding that that's the trade you're making, well, that's the key to figuring out if this strategy is right for you.